Hey everyone, it's Chase Vickers from MoonShot Money. My brother Isaac is behind the camera. In today's video, we're going to discuss real live examples of recent moonshots that we've had in our investments. We're going to put it all together right now. Are you ready? Let's go. We're getting specific in this video, but let me remind you, we're not financial advisors and we're not recommending you to buy any stock that we might mention here. We are value investors first and foremost. Every once in a while, you get opportunities to buy businesses at such a steep discount that you may get to double your money in a short amount of time, or save 75% or 50% returns in mere weeks. These opportunities are what we call moonshots. Over the last several decades, the stock market as a whole has risen on average 8% per year. That means you can buy a total market index fund or an exchange traded fund, ETF, that carries the whole market. You can expect on average an 8% return, which is pretty good. We want to beat that on average though by trying to pick winners and leaving the losing companies behind. If you can successfully do that, which we normally do, our investments grow at faster speeds. If you want to just buy the market and not worry about a thing, you could buy the S&P 500, which is a basket of the 500 largest companies. The ticker symbol is SPY. You could buy the whole market with a Vanguard fund like VTI or VOO. These funds have very low expense ratios as well. Now, how do you go about beating the market? Several factors come into play here, but there's a lot of common sense involved as well that anyone can use. We buy great businesses that are very deeply discounted on sale because of the situations that we can understand. If we can see the reason for the stock market price falling so hard, and we can also see the reasons why the stock prices will go back up over time, that's when we buy. Let's talk specific now. The worldwide virus we have all experienced over the last several weeks has caused different sectors of the market to be crushed. If you're told to shelter in place, don't travel, shut down your business, common sense immediately tells you a few things. Oil prices are going to crater because cars won't be on the road and planes won't be flying. The travel and leisure industry will be hurt, specifically say hotels and amusement parks. Restaurants are going to be crushed because their doors will be shut. We know why the prices are going down. Now we have to ask ourselves a simple question. Will planes ever fly again? Yes. Will people ever drive again? Yes. Will Disney ever reopen? Yes. Will people ever stay in hotels again? Yes. So can you begin to see where common sense comes into play here? Now, situations like we have just experienced certainly put stocks on sale, but you can't just buy any and all companies. Why? Some businesses just cannot weather the storm. Some businesses have too much debt. Some operate on very slim margins. So the shutdown has crippled their ability to survive. But some companies have low debt, large cash reserves, great moats, great management teams, and they can hunker down and just wait on the storm to pass. Those are the companies you want to buy. Hopefully this is beginning to make sense to you. Here's a real example. A few weeks ago, oil prices were as low as they've been in many, many years. Not only was the shutdown going on at the time, but there was also a price war between Russia and Saudi Arabia. A double blow to oil stocks. The talking heads on the financial channels were saying things like, you cannot invest in oil right now. Crude oil prices actually went negative because there was no place to store the surplus. Some people were even saying, I wouldn't touch oil with a 10-foot pole. When you hear things like this, bells and whistles begin to go off in our heads. Remember that what Warren Buffett said, you want to buy a great company when it's on the operating table. We began buying oil stocks as the prices began to steeply fall and continued to buy all the way down, and then loaded the truck when crude oil began to recover from the negative prices. My dad tells this story. He was at the gas station filling up his truck, and all the pumps were occupied with people filling up their cars. He looked at the pump and the price was $1.35 per gallon, and he thought to himself, when was the last time I saw prices this low? probably when he was a teenager or something. As he stood there filling up his truck, he knew planes would fly again. Cars would soon be on the roads again, and we would never be so lucky as to have oil prices stay this low for very long. He knew if there was anything he could count on, it was higher gas prices coming, which would mean higher stock prices for oil companies. He put the pump handle up, closed the gas tank lid. He pulled around to a parking place and moved more money into his brokerage account and bought more oil businesses that met our criteria. As of now, his assumption was right. The country is opening back up and prices are on the rise. We have experienced over 100% returns, 60% returns, and 50% returns, and the stock prices are not even close to where they were before the shutdown. Opportunities still abound. These are moonshots. One of our extended family members took advantage of the crushed hotel industry. She bought a large hotel REIT, which is a real estate investment trust, at less than half of its book value. Was it risky? Yes. Was it a guaranteed return? No. But her common sense told her the country would one day soon open back up, and name brand hotels would one day be completely booked again. Guess what? Hotels are just now beginning to recover, and she's already up over 100%. Moonshot. Her regret? I wish I would have bought more shares. Common sense should tell you a great company like, say, Disney, with all their parks closed, would be something to potentially invest in. Disney's stock price already way off the bottom, and parks aren't even open yet as of today. But their streaming services is picking up momentum. With interest rates so low and the looming threats of people and companies defaulting on loans, bank prices just might be at 52-week lows. If you thought that, you'd be exactly right. Currently, there are some great banks that you can buy at deep discounts, like half of their book value. Airline companies, they should be suffering right now, and they are. Air travel bookings are lower than 9/11 levels. Are there opportunities to invest? We think so. A couple of airline companies have stronger balance sheets than their peers. They also have a long runway to recover their price. Boeing has had more than one major problem in the last year or two, but they are only one of two companies that manufacture commercial airplanes. They are also a major defense contractor for the United States military. Opportunity? We think so, especially when it was at 5-year lows. I hope you can see how strategic value investing can be good practice for you, your family, and your future. If you took advantage of opportunities like we've seen here lately, you'll likely see price appreciation over the next several months, as well as collecting some sweet dividends from some of the great companies you bought. These are real live examples of how we invest. Know the companies, know the situations, have capital to deploy, and when the sale price happens, just load the truck. So if you found this video helpful and you'd like to be a part of our community, please subscribe below and give us a thumbs up. And always remember, if you're not interested in your money, someone else is. See you next time.